Do you have an investment policy statement? Does it itemize the things you know about and can control? Does it give you the rationalization for the investment strategy that makes sense based on the things that are important to you and your likelihood of meeting or exceeding those goals? The Russell 3000, the Barclays Ag Bond Index, or some other benchmark that really has nothing to do with you achieving your goals and your aspirations. But this is the traditional way of investment management, performance measurement, and I would argue it doesn't make a lot of sense in terms of successful investing. Hello, everyone, and thank you for joining me today. This is Mark Shupe, and this is the Moneyball Method podcast. I'm the author of the book, The Moneyball Method, a Middle-Class Manifesto for Objective Investing. And today I want to continue the conversation we started last week, which was titled Financial Independence, What Does That Mean? At the conclusion of last week's podcast, I mentioned that financial independence requires an understanding of both money and independence in order to integrate those into one concept that is important to us as individual investors. And in turn, we measure performance, investment performance, based on a new benchmark that is your life, you as the investor. And that is where I want to begin today, talk about that investment performance benchmark, and in particular, how we measure investment returns. The title of today's presentation is Investment Returns, When Do They Make Sense? And analyst predictions and percent rates of return is where we're going to focus this conversation as we talk about the traditional ways of thinking about returns and measuring them. Let's start with the analysts. Who are they? Where do they come from? How do they think? To quote my book, all economists and investment analysts were trained in government schools that promote demand-side economics and the negative externalities of inefficient markets. As you may recall from previous podcasts, I don't believe that demand-side economics is useful. It only serves the interest of central planners and government bureaucrats. Yet nearly all economists and analysts and managers use them in terms of GDP as the performance benchmark for the U.S. economy. Gross domestic product is a demand-side metric. It measures consumption. It measures the purchases of consumers, government, and businesses. However, as we know from Say's law of markets, production precedes consumption. Supply creates demand. In fact, it is the supply side that is the dominant one in sound economic theory. Regarding negative externalities, externalities is not really a valid concept, and it ignores the positive externalities that occur in a free market system. But really, the primary reason that analysts exist and use predictions about the future of market performance is they believe markets to be inefficient. They believe that investors tend to be irrational, that we make emotional decisions based on whims and based on faulty or incomplete information. And as experts with certified financial analyst certificates or other credentials from government-funded schools, they believe that they can outperform the market because they are more objective and they are more knowledgeable about the inefficiencies of markets. Let's talk about this in terms of baseball. After all, the title of my book is The Moneyball Method. What were the traditional metrics that were used by Major League Baseball scouting departments and media to measure offensive talent? Home runs were a common statistic. However, it doesn't measure how many strikeouts the batter may have experienced before hitting a home run. Batting average or team batting average was used by managers to talk about the offensive talent that might be on the roster and in the starting lineup. However, batting average includes things that a player cannot control. Then there's also runs batted in. That's a typical RBI is a typical statistic used by the scouting department and baseball pundits. Yet the batter does not control that either because they cannot control who's on base when they enter the batter's box. And in traditional investing regarding performance measurement, investment returns, the first one is absolute returns. How much did I earn on a percentage basis? Second one is peer group returns. How much did I earn on a percentage basis relative to other managers within that sector or within that style of investment management? The third one is relative returns. How did I perform relative to some arbitrary benchmark like the S&P 500, the Russell 3000, the Barclays Ag Bond Index, or some other benchmark that really has nothing to do with you achieving your goals and your aspirations? But this is the traditional way of investment management, performance measurement, and I would argue it doesn't make a lot of sense in terms of successful investing. But it really boils down to return management. That is what nearly every financial advisor, portfolio manager, strategist, that is their value proposition, is managing rates of return. To quote my book, the goal is to outperform. That kind of outperformance is only possible with higher risk exposure plus a superior talent for flipping quarters. What that means is that capital market performance is not predictable. We can't control it. And managers that do outperform can't do it consistently over a long period of time without taking excess risk. And even then, they're exposing investors to underperformance risk. So what is the difference between return management and the Moneyball method? The Moneyball method is about wealth management. It is about dollars of future wealth. It is about the new performance benchmark that I discussed in the previous podcast. To summarize, what I've done with the Moneyball method is ask you as a reader, as an individual investor, to do a reality check. What are the traditional best practices and do they work for you? By combining the intrinsic value of market tactics, such as tactical rebalancing, with the subjective value of risk tolerance questionnaires, which really are not a good way to make investment strategy decisions, investors pay for the opportunity to underperform. That is a risk. Underperformance risk is something that is easily avoided, yet one that is rarely discussed within traditional common wisdom. So what do we do with the Moneyball method? The traditional best practices use forward projections about investment returns. They use limited time frames when looking at historical returns. They use industry benchmarks to compare relative performance on a percentage basis. And they use recent history to project into the near future. The Moneyball method replaces all of that and reverses the order. We use the most reliable historical data sets to understand the behavioral characteristics of each individual asset class. And we go back as far as possible for the most reliable data because there are things that had happened decades ago that can and will happen again. But we replace all of the benchmarks that are used by the industry with the one that really matters, and that is your life as an investor. What are the values, goals, and aspirations we're trying to achieve? How much do they cost, and when is the money needed? What is the likelihood of being able to meet or exceed those goals? That is when investment returns make sense. And the way we measure that is in terms of funding status. The funding status uses probability analysis to try to understand the uncertainty of capital market performance. We do not make predictions. We do not project into the future how anything is going to perform, but we do take into consideration every possibility imaginable in terms of capital market performance based on the most reliable long-term historical data sets, and do that in the context of your particular cash flow expectations. That is how we measure funding status. It is forward-looking, and it is based on dollars of future wealth. And this is directly relevant to what Billy Beane experienced with the Oakland A's. He had to discover something. He had to reject baseball's traditional best practices, find a reliable way to judge talent, and find a way to measure performance that was reliable in terms of winning games, selling tickets, and earning money. To quote my book, their solution was a reliable historical data for all major league and college players, statistical analysis to make practical use of it, and the independence to replace traditional thinking. This was radical. This was a departure from the traditional way Major League Baseball teams were managed. And this gets to the crux of the Moneyball method with regard to capital markets. We use the most reliable historical data sets to understand how different asset classes are likely to behave in the future, whereas Billy Beane replaced RBIs and batting averages with on-base percentage. We use correlation coefficients to judge talent. Does this manager perform exactly according to the benchmark that we modeled when we did the random simulations to calculate your funding status? Billy Beane used slugging percentage. Does the batter have the ability to hit balls that are in the strike zone for doubles and triples and home runs? As mentioned in the previous slide, we use funding status in the Moneyball method. Strikeouts. Does the pitcher get batters to strike out, preventing them from getting to first base? And do batters get to first base without swinging at bad pitches? We use risk capacity as a measurement of performance, of investment returns. What is your ability to withstand a severe market event? How much can you lose before you become underfunded? Risk capacity is a much better way to understand investment returns. This is when they make sense. With the new performance benchmark, meaning winning games, Billy Beane had to have ways to judge talent. The primary statistics were the walks and home runs allowed by the pitchers, but they were not the cause. Pitching success was getting batters to swing at bad pitches. And it really boils down to that. If the pitcher can get batters to swing at bad pitches, they get outs. If the batters avoid swinging at bad pitches, they get to first base. That is what we do when we hire talent, when we measure investment performance, to understand returns. What is the likelihood of the managers that we hire on your behalf of getting you to first base in scoring position and meeting your future cash flow expectations? With regard to capital market assumptions, those are median return, correlation coefficients, standard deviation. Median return is a statistic that is largely used improperly and poorly understood within the industry. Fudged median return numbers misunderstand the data, misrepresent its proper use, and misrepresents the sequence of return process. What am I talking about here? It goes back to the first slide. Common conceptions, making projections into the future using median expected return, or using conservative assumptions, using a lower return than the historical data would suggest, or limiting the time frame, using only the return data from the previous 10 or 20 years. As mentioned, there are three aspects to each asset class that are its defining attributes, its characteristics. This is modern portfolio theory. This won a Nobel Prize for Harry Markowitz with his paper that was written in 1957. As I mentioned, median return, standard deviation, and correlation. What we can control is our exposure to market risk. We can measure sequence of return risk, and we also can understand our longevity risk. These are the things we know about or can control. We can't predict or control the future, but we can control our exposure to market risk. We can simulate all potential outcomes with regard to any particular investment strategy by running sequence of return scenarios, and we do that based on the rest of your life, age and life expectancy, to help avoid running out of money. Forecasting. This is a common use of investment returns, trying to understand and predict the future. Prior to its baseball application, computer simulations using price data was developed as an information technology for Wall Street speculation. We are using the same tools with big data, computing power, using and conducting random simulations of all potential investment outcomes for any given investment strategy. We are not forecasting, but we are anticipating the possibility of extreme market events. We want to be able to calculate your funding status and know, out of running 1,000 random simulations, 1,000 potential lifetimes of investment experience, how many of those met or exceeded your spending goals? This is the stuff of high-tech random simulations, data processing using the most reliable historical data sets available. Instead of trying to beat the market, what is it we can control? We can control overspending risk. That is probably the top cause of investment strategy failures, is not managing the cash flow strategy. As mentioned earlier, we can control underperformance risk. This is done through index funds, passive investing, very low cost, very high correlation to the asset classes that we model when we calculate your funding status. We can reduce assumption errors. Anytime we use an economic forecast, how many potential assumption errors are built into that? Anytime we make a prediction about the future of stock market returns or interest rates or economic performance, how many potential assumption errors are built into that? Risk tolerance questionnaires, tactical rebalancing, technical analysis. How many potential assumption errors are built into those tools? Rebalancing risk. That involves transaction costs, and it may or may not improve your likelihood of success. That's a potential assumption error. Concentration risk. If you have more than 5% of your financial resources in the securities of one company, that's a concentration that we can easily manage and eliminate. Illiquidity risk. Owning private equity, limited partnerships, things of that nature that take time and cost money to turn into cash if and when you need the money, also pose risks that we can easily manage or eliminate. So instead of trying to beat the market by predicting the future and taking on a boatload of potential assumption errors that we can easily avoid, the Moneyball method is about controlling the things that we can control. To summarize, wealth management versus return management, Moneyball reverses everything. And I'm quoting from my book. Instead of predicting the future and measuring performance in the rearview mirror, the objective investor chooses the destination and uses historical data for the navigational chart. Again, this reverses everything. We're not trying to predict the future, but we are trying to take ownership of the future with regard to our cash flow expectations and the cash flow strategy decision. And instead of tainting the historical data with conservative assumptions or limited time frames, we use the most reliable long-term historical data sets possible. This puts you in control. This is when investment returns actually make sense, when the performance benchmark is your life as an investor. As mentioned earlier, we use statistical analysis. We use probabilities to calculate your funding status, to calculate your spending capacity. How much can I spend without becoming underfunded? To calculate your risk capacity. How much can I lose before becoming underfunded? To have a contingency plan in case of an extreme market event or changing life circumstances that cause you to become underfunded. We have a fallback plan in advance before it happens. And we're able to do what-if scenarios on your changing circumstances. This is essential in order for you to be able to understand investment returns and have them make sense for you. As mentioned in a previous podcast, we want to be able to answer the question, what am I doing and why? And that's where we put it in writing with an investment policy statement. This is a document that takes into account everything we know about and can control that went into the investment strategy decision, your asset allocation between equities, fixed income, money market funds, real estate. To quote my book, the remedy to asset value and consumer price fluctuations begins with regular monitoring and the facts and values matrix. It ends with dynamic rebalancing according to the investor's contingency plan and changing priorities. Do you have an investment policy statement? Does it itemize the things you know about and can control? Does it give you the rationalization for the investment strategy that makes sense based on the things that are important to you and your likelihood of meeting or exceeding those goals? What are some of those things we know about and can control? What are the details that go into your investment policy statement? Certainly personal information, age, marital status, family, other obligations, your financial resources. It could be taxable accounts. It could be tax qualified retirement plans. It could be tax-free municipal bonds. It could be bank deposits or annuities. The tax status of your financial resources matters a lot, as well as their value. What are the cash flow objectives we're trying to fund? This is critical. This is your spending strategy, as well as your saving strategy. The facts and values matrix. How do all of these things work together? What is the values hierarchy that went into the investment strategy decision, including your exposure to market risk? What are the range of return assumptions, meaning the capital market assumptions for the asset classes that are built into the investment strategy decision? For the objective investor, those are going to be the long-term historical data sets, and in particular, what I use is from the Center for Research and Security Pricing at the University of Chicago. The asset allocation strategy itself. How is it being implemented? That goes into the investment policy statement, as well as your funding status on the date that the investment policy is put into place. The recommended strategy that is being implemented is the plan of record. What is the funding status for that plan of record? And what will the funding status be to become overfunded or underfunded? What is your risk capacity? How much can you actually afford to lose, whether it's due to overspending or market volatility before you become underfunded? This is when investment returns make sense. What I'm talking about here is true wealth management. The Moneyball Method uses inductive reasoning, the objective evidence of time-weighted historical returns that drive dollar-weighted probabilistic conclusions. Yes, we do use time-weighted historical returns and to understand the correlation of the managers that we hire, their ability to manage and control what it is we want them to do with regard to the asset classes that we modeled when we calculated your funding status. That is true wealth management. That is when investment returns make sense. I hope that this was helpful, and I look forward to talking with you next week about capital markets. How do they work? Thank you, and have a wonderful day.